Now you've got to hear this. I just dug into this bombshell report, and it's going to flip everything you know about the economy upside down. In fact, it's so shocking, the mainstream media didn't even pick it up because they want you to believe that everything is fine. And it's not. It's far from it. In fact, it's so bad that it's worse than the global financial crisis. Right now, the commercial real estate market is crashing hard with delinquency spiking to 7.46% in October. And get this, office loans, they just hit an all-time high delinquency rate of 11.76%. That's right, an all-time high delinquency rate, which stocks are sitting at their all-time highs. And if you're watching this right now and you have hard-earned money in stocks, real estate, or even private credit, what you're seeing is the setup for the biggest wealth wipeout since 2008. And you might remember that killer trade we dropped to our CTA Timer Pro subscribers for Monday morning, the one with the 88% win rate. It's up huge in one day, and it's up again today. And get this, right now our board has an 89% win rate of all our open trades. Now grab those links in the description below for your 30-day free trial before it's gone. Stay tuned to the end of the show for more information, because I want to escalate this fast because time is running out. You may only have weeks, let alone months, and you can't wait. This commercial mortgage-backed security spike means commercial mortgages are defaulting left and right. Delinquent balances are jumping $1.1 billion to $44.6 billion, while the market for this is shrinking. And it's terrifying for offices because high-paying jobs are vanishing right now, and tenants, they're bailing. In fact, earlier this year, the office delinquency rate hit new record highs of 11.08% in June, and then again 11.66% in August, now both eclipsed by October's new peak. My friends, this isn't getting better. It's getting worse and fast. And can you imagine the pain? Your retirement fund, it evaporates overnight because you've got a bunch of REITs tied to these loans and they tank. Your family's nest egg slashed as commercial crashes infect residential values. Vacations get scrapped, college dreams deferred, and retirement, you can cancel it. It's even hitting multifamily, which saw the second largest rate increase to 7.12%. And get this, it topped the 7% threshold for the first time in nearly 10 years. This is staggering. And look at this chart of commercial mortgage-backed security delinquency rates by major property type. You can see the trend is rising and it's escalating fast. And that's right, you stack on top of this. You look at apartment complexes, they're foreclosing. And what does that mean? Rents are going to spike, and your passive income stream, it's going to be gone. And even worse, and we talked about this yesterday with private credit, these funds could gate redemptions too. That means no escape, and you're trapped while your wealth burns. And now hang on, because I'm going to show you why this is about to get a whole lot worse. And if your money's exposed, you want to run for the exits, my friends, and you want to run fast. Now let's dive into this delinquency spiral because it's blowing my mind and it's going out of control. First up, the weekly ADP jobs report. They just said that 13,500 jobs were shed per week in November. That's the worst since August. And you can see the relationship here. Look at this chart. Jobs right now are plummeting. And this is frightening. And ADP's Nella Richardson, she warns, consumer strength remains in question as we enter the holiday hiring season, adding, we might be playing into delayed or curtailed job creations. My friends, this is serious because we already know there's going to be fewer holiday jobs. And what does that mean? Less demand for office space. For tenants, they're not going to be able to pay their rent. Delinquencies, they're going to explode even higher. And can you imagine this? Your high-paying job goes away, your office building is empty, foreclosures are everywhere you look. And that's the pain that's coming. But it doesn't stop there, because you think about who's holding all these loans. The small and mid-sized regional banks that I've been warning about for a long time. What's facing them? Insolvency. The stock market, it's going to be toast. But hold on, it's escalating. Because today we got the Conference Board's gauge of consumer confidence. It decreased 6.8 points to 88.7 in November. Check this out. It's the most in 7 months, and it's on growing anxiety about the labor market and the economy. So what we're seeing here is anxiety means shoppers, they're going to pull back. Retail spaces, they're going to empty out in the first part of the year, and that means those mortgage-backed securities for malls and office spaces, they're going to implode even further. Could you even imagine your local strip mall boarded up? And if the holiday season is a bust, my friends, and we've talked about how likely that is, and I'm going to give you some more evidence here in a moment, it's not just probable, it's reality. And if you think the bottom is in and it's going to get better, check this out. A gauge of expectations for confidence over the next 6 months declined to the lowest since April, while measures of present conditions slumped to more than a one-year low. And so what we're facing here is consumers are still spending, but their outlook, it's bleak. And the issue is they're complaining about prices and inflation. And what does that mean? Their dollar doesn't go as far. And on net, their spending is going to drop. And so what does this mean for cash-strapped businesses? Well, we're going to tie this all the way back to rising delinquencies, because if they don't get the sales they need, that means they're going to be forced to skip payments to stay alive. And you can see, going into early next year, this whole thing is going to come crashing down. But wait, it's already impacting retail sales right now, because the value of retail purchases not adjusted for inflation increased 0.2% after a 0.6% gain in August. Excluding cars and gas, sales rose a scant 0.1%. And look at this chart. There's a clear deceleration in spending. You can see it from a mile away. And on top of that, according to TransUnion, over half of Americans say they expect to spend the same as last year. But when you adjust that for inflation, they're actually going to spend less. And you think about all of these inventories these businesses have, it's not going to move. This whole thing, it's going to unwind and fast. Let's take a look at this chart of the University of Michigan Consumer Sentiment Survey in blue against advanced retail sales in red. And what you can see very clearly, it's predicting a huge plunge in retail sales. And as sales fall, more commercial properties are going to starve for cash flow, more defaults. They're just going to pile on and on. My friends, this isn't stopping. Now you've got to see this, because this confirms everything I've been showing you. Take a look. The producer price index rose 0.3% from a month earlier and was unchanged at 2.73% from a year earlier. So I want you to understand this very clearly. If businesses can't pass on costs to consumers, the entire commercial debt tower is going to collapse. Now, it's all validated in this next chart. It's confirming everything. Let's take a look, because the producer price index by commodity from Final Man, you've got that in blue. Yes, the delinquency rate on commercial real estate loans in red. Whoa, look at this. Every time producer prices come down, what do you see happens with the delinquency rate? It goes up. And we know this is coming, and fast, because oil prices right now, they're dropping. And I want you to see this next chart. I want you to see the relationship, because producer prices, they follow oil. Let's take a look, because now we've got the producer price index still in blue, overlaid against the West Texas intermediate crude oil price in red, and it's obvious, it's clear. Oil is predicting that producer prices are coming down. What does that mean? Delinquencies are about to rise even more. My friends, this is the spiral I'm warning about. But what's the big one? Well, I saved that for last. Now, remember yesterday we talked about private credit, and what was the one thing that was going to just set that whole thing ablaze? It was lower interest rates. The 10-year Treasury is now plunging back toward 4% amid more weak jobs data. My friend, what are you seeing in the market right now? Investors are fleeing to safety, and they can see what's coming, and now you can too. Because it's obvious. Let's look at this next chart of the delinquency rate on commercial real estate loans in blue against 10-year Treasury yields in red. And here's your proof. Lower interest rates will not work. You can see throughout history, it only makes it worse. Because what you're actually seeing in this chart is interest rates, they're forward-looking. They can see growth and inflation expectations. What did the Conference Board just tell you? That the outlook is bleak. And what did the ADP just say? The labor market's unwinding. And then you go all the way back to the commercial delinquencies. You can see this whole thing gets tied together and is spiraling out of control. And all the bond market is doing right now, it's confirming what's coming. Now, my friends, this connects all the dots together. I want you to understand this, because when jobs vanish, offices, well, they empty. Confidence, you can see it crashing right now. And what does that mean for retail sales and inventory-laden businesses? Well, they're going to die. Prices, all that worry about inflation stalls out. Yields plunge. Regional banks, they implode. And those delinquency rates that are sitting at 7.46% right now, you're talking 15, maybe upwards of 20% by 2026. Again, this isn't just coming. It's already here, and it's set to accelerate. But now I've laid out the doom spiral here, but my friends, you don't have to be a victim. I want you to take control right now. Now, what's the first step I want you to do? You've got to audit your portfolio today. Scan for any REITs, bank stocks, or funds with commercial mortgage-backed security exposure, not to mention that private credit garbage we talked about yesterday. What do you want to do? Shift 20 to 30% of it into short-term treasuries, possibly gold. Remember what Gunlack said? He's the bond king, and he said you should buy cash. Remember, I've told you, you want to be along the dollar here. And you need to do this before the next delinquency report drops, because based on the trend, it's only going to get worse. And when the masses start to figure out what's going on, those exits, just like with private credit, they're going to get locked up. Number two, you got to build your emergency shield, stockpile 6 to 9 months of cash and high yield savings while they're still available. Again, with the stock market rallying here, step 3, rotate some of those high tech stocks, take some profits out of that. And again, cash, treasuries, gold, that's your insurance policy. And if the regional banks start to fail or private credit starts to blow up, remember, credit is going to freeze here. So you got to get ahead. If you've got some variable rate debt, you got to pay that down. Or if you can tie it up in a fixed rate loan, that's going to be to your advantage. So what indicators can you be watching going forward to see if this thing's going to blow up? You want to keep an eye on crude oil, the producer price index, the delinquency rate. And don't forget, the best real-time indicator you have, that's treasury yields. If they go down, it's bad. Now, I want you to do this now because I don't want to see you get wiped out. And if you do these things, you won't just protect your wealth, you're going to create a fortune. You can also join our CTA Timer Pro community. Grab that 30-day trial link in the description below, because that 88% win rate trade, it's one of many right now. Again, our board of open trades, we have it 89% of them are up. Now let's dive in on how we're putting the odds in your favor when it comes to trading. Let's take a look at that trade, because here it is. This is what we put out to our subscribers. We told them to buy on the open on Monday. We said that trade had an 88% expected win rate over the coming 10 days. 1 day return up 0.91%. And again, it's up today on top of that. Now, how do we do this? What is our CTA Timer Pro? Well, each and every day we look at the machine positioning across the broad equity, bond, currency, and commodity markets, because what we're looking for is when machines are about to make a big buy, because we want to position our subscribers ahead of that. And then when machines sell, we want to get out. But we've taken this to another level, because these machines trade on threshold levels, and we know what they are, but I've optimized them and fully back tested them, so I can tell you exactly which ones trigger to put the best chance of making money in your pocket and the biggest return. Now, what do you do when you sign up? Well, it's really simple. All you have to do is scroll down to our latest entry. They're selected there by date. You'll click on that, and what do you find? We give you the latest trades for the coming day, give you the win rate, the expected return, stop loss levels, everything. We update you on our existing trades and stop loss levels, and we give you all the optimized trades based on our report from that day. So you get the tradable signals. You get my opinion on the best trades. You know all of them optimized and back tested. You get risk control levels, a full tracking of all open trades and returns, a weekly update. And here's the best part of all. Whether you're brand new to trading or you're a seasoned trader, I'm going to give you 30 days to try this out at no charge. Why? Because once you see our results, you know it's better than everything else on the market. All you got to do, grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.